Click the bell icon to get latest videos from Ekeeda.
Hello friends, let us discuss now one question of admission of partner where we are required to do journal entries. Let us go through the question. Paresh and Naresh were partners sharing profits and losses in the ratio of 3/5 to 5th, that is 3:2. On 31st March 2012, their balance sheet was as follows. Balance sheet as on 31st March 2012. Sundry creditors, reserve fund. Reserve fund will be distributed among all partners in the ratio of 3:2. Sundry creditors 30,000, reserve fund 10,000, capital Paresh 72,000, Naresh 48,000. This will be transferred to capital account credit side. Asset side, cash 500. Sundry debtors 45,000 less RDD 500. So it is 44,500 net debtors. Stock 17,000, investment 24,000, plant 30,000, building 44,000. On 1st April 2012, Dinesh was admitted into partnership on following terms. So new partner is Dinesh. Dinesh should bring 36,000 as capital. So money comes in, cash will be debited and Dinesh capital will be credited for 1/5 share in future profit. So new partner's profit share will be 1/5. Valuation of goodwill of the firm was to be made at 2.5 years purchase of average profit of last 3 years, which were 32,000, 54,000 and third year 49,000. Dinesh is to bring goodwill in cash equal to his share in future profit. We are required to do working note for this adjustment. RDD is to be raised up to 1,000. Already RDD we have here 500. So we'll have to increase RDD by 500. So we'll have to add 500 to RDD. Second effect, revaluation account debit. Closing stock to be valued at 15,000. Here stock is 17,000. So we'll have to reduce it by 2,000. Second effect, revaluation account debit. Building to be appreciated by 5%. Revaluation account credit and we'll have to add 5% to building on asset side. Pass necessary journal entries in the books of firm and prepare balance sheet after the admission of Dinesh. Let us do first working note for goodwill. Valuation of goodwill of the firm was to be made at 2.5 years purchase of average profit of last 3 years. Step 1, find average profit. That is equal to total profit divided by number of years. Total profit of 3 years 1,35,000 divided by 3. So average profit is 45,000. Goodwill of the firm was to be made calculated at 2.5 years purchase of average profit. Step 2, find goodwill. Average profit multiplied by number of years purchase. Average profit 45,000 multiplied by number of years purchase, that is 2.5. So the amount of goodwill is 1,12,500. Now we are required to calculate new partner's share. Total firm's goodwill multiplied by Dinesh share. Share of Dinesh 22,500. Let us start with journal entries. First entry is for dividing reserve fund between old partners in old ratio, that is 3:2. Reserve fund account debit 10,000 to Paresh capital 6,000 to Naresh capital 4,000, being reserve fund distributed. Next entry is Dinesh should bring 36,000 as capital. So that is the amount of capital brought by Dinesh, 36,000. Cash account debit 36,000 to Dinesh capital account 36,000, being capital brought by him. Goodwill of the firm to be valued at 2.5 years purchase of average profit of last 3 years, which were first year profit was 32,000, second year 54,000, third year 49,000. We are required to take average of this and then multiplied by 2.5 to get the amount of firm's goodwill. Then we are required to calculate Dinesh share based on his profit share, and that amount equal he will be bringing cash, that is his share of goodwill. We already done working note for this. Average profit of the firm 45,000. Firm's goodwill we have valued 1,12,500. Dinesh share is 22,500. So he brings cash equal to his share of goodwill 22,500. Cash account debit 22,500 to goodwill account 22,500, being cash brought by Dinesh for his share of goodwill. This is goodwill brought in cash and retained in business. That means this amount will be distributed among all partners and they will not withdraw this amount, which will become part of their capital. So our next entry will be goodwill is to be distributed among all partners in sacrifice ratio. In this question, they have said that new partner is admitted for 1/5 share. When new partner share is expressed like 1/5, 1/3, 1/4, then we are required to understand that whatever is the old ratio, same is going to be sacrifice ratio. No working note is required. Working note will be required when specifically question gives new firm's ratio, like new ratio will be 5:3:2. Then we are required to verify whether sacrifice ratio is different or it is same as old. When it is given 1/4, 1/5, like in this question it is given 1/5, then we should understand that whatever is the old ratio, same is sacrifice ratio. Goodwill account debit 22,500 to Paresh capital account 13,500 to Naresh capital account 9,000, being amount of goodwill distributed between all partners in sacrifice ratio, that is 3:2. RDD is to be raised up to 1,000. Here RDD we have 500. It is raised up to 1,000 means it has to be increased only by 500. Entry is revaluation account debit 500 to RDD account 500, being RDD raised. Closing stock is to be valued at rupees 15,000. Here closing stock we have 17,000. That means it is reduced by 2,000. Revaluation account debit 2,000 to stock account 2,000, being stock reduced. Building to be appreciated by 5%. Here building we have 44,000. This is required to be appreciated by 5%, which comes to 2,200. Our entry is building account debit 2,200 to revaluation account 2,200, being building appreciated. With this we have given effect to all adjustment in journal entries. To find out revaluation profit or loss, we are required to prepare revaluation account as working note. Along with that, we'll be preparing partners capital account as working note so that we can find out final balances on partners capital, as we are required to prepare balance sheet as a part of answer. As a working note, we have prepared revaluation account and partners capital account. Let us do posting there. Cash 500. There is adjustment on cash as new partner has brought cash for capital as well as for goodwill. We'll record cash on asset side 500 inner column, leaving space for adjustment. Sundry debtors 45,000 less RDD 500. There is adjustment on RDD. Sundry debtors 45,000 less RDD. We have left space over here to do adjustment. Stock 17,000. We'll record this in inner column as there is adjustment on stock. Investments 24,000. Balance sheet asset side. Plant 30,000. Building 44,000. Let us go for effects. Dinesh should bring 36,000 as capital for 1/5 share in future profits. Opening balance of cash 500. We added Dinesh capital 36,000, so it is 36,500. This will have another effect in Dinesh capital account on credit side. Capital of other partners, Paresh 72,000, Naresh 48,000. Reserve fund 10,000 distributed among old partners 6,000, 4,000. Partners capital account credit by reserve fund, Paresh 6,000, Naresh 4,000. Goodwill of the firm we have valued, and here new partner brings cash equal to his share. Entry we have recorded cash account debit to goodwill 22,500. This will increase cash by 22,500. So amount of goodwill is added. So finally cash becomes 59,000. Goodwill brought in cash is distributed among partners in sacrifice ratio. Entry is goodwill account debit to Paresh to Naresh. Partners capital account credit by goodwill, Paresh 13,500, Naresh 9,000. That is for distribution of goodwill, and goodwill is retained. RDD is to be raised up to 1,000. So actual RDD is raised by 500. One effect, revaluation account debit to RDD 500. Second effect, opening balance of RDD is 500. It is increased by 500. So it is now 1,000. 45,000 minus 1,000, net debtors are 44,000. Closing stock is to be valued at 15,000. Stock is 17,000. So it is reduced by 2,000. Revaluation account debit to stock 2,000. Balance sheet, stock is reduced by 2,000. So it is 15,000. Building to be appreciated by 5%. We have calculated the amount is 2,200. Building 44,000, added appreciation 5%, 2,200. So it becomes 46,200. We have given effect to all adjustments. Let us find out now revaluation profit or loss. We have closed revaluation account. It is showing loss of rupees 300. This will be distributed in the ratio of 3:2 between old partners Paresh and Naresh, 180 and 120. This will be debited to their capital accounts. We have closed partners capital account. We got balances Paresh 91,320, Naresh 60,880, Dinesh 36,000. These balances are transferred to the liability side of new balance sheet. Balance sheet liability side, capital of Paresh 91,320, Naresh 60,880, Dinesh 36,000. In old balance sheet we have creditors 30,000. There is no change. Same value is transferred over here. Now we have closed balance sheet. Asset side total we got 2,18,200. Liability side also we got same total 2,18,200, which means our new balance sheet is tally. Let us record entry for loss transferred. Paresh capital account debit 180, Naresh capital account debit 120 to revaluation account 300, being revaluation loss transferred. In this question we learn how to do journal entries in problem relating to admission of partner. We are required to prepare as a working note revaluation account to find out revaluation profit or loss. Thanks for watching this video. Stay tuned with Ekeeda and subscribe to our channel Ekeeda. Thank you.